I would like to talk about the disadvantages, the downsides of finance first impact investing. So let's consider the atypical downside of finance and first impact investing. While finance first impact investing offers several benefits, it also, have some disadvantages we need to take into consideration. Number one is potential for compromised impact. Potential for compromise and impact. The focus on financial returns may lead to compromises, on the intended social or environmental impact, potentially prioritizing profits over genuine positive change. The initial desire, the initial mandate, the initial aim may be to create impact in line with, a profit-making motive. But along the line, there could be that the emphasis on social impacts and then an overemphasis on profits. So in that case, there is a compromise right from there's a compromise along the line. Number two is limited scope of impact. Limited scope of impact. Our investors may choose projects that offer higher financial returns rather than those with potentially greater social or environmental benefits but lower profitability, limiting the overall impact achieved. Human beings generally, when it comes to generating returns, the desire to generate profit might overcome that tendency to create impact. So in this case, discover that investors may go for projects that will give them more profits and less impact instead of less impact and instead of more impact and less profit, or at least let them balance the two. But in some cases, they will be carried away by a desire to, emphasize profits and kind of de-emphasize social impacts. It happens, and that's a typical drawback of this particular strategy. Number three is short-term focus, short-term objective. So some finance-first investors may prioritize quick financial returns, neglecting long-term social or environmental sustainability in the process. They may want to, okay, I'm into this for money, let me make my money first and then get away. No. If you come in with a short-term mentality, you will not be able to create impact because impact takes time. It takes a longer duration. And so once there's that particular short-term focus, the entire aim is kind of defeated. Yes, the two cannot go hand in hand. Social impacts, environmental impact, sustainability cannot go with a desire to make quick money. It doesn't rhyme. Number four is risk of greenwashing. Companies may engage in what is called greenwashing, or kind of or misleading marketing to appear socially responsible while primarily focusing on profits, making it challenging for investors to find genuinely impactful opportunities. Some companies, they will come in and brand themselves or market themselves as socially responsible simply to attract, investors. But in the real sense, they're not actually, what they say they are. They're not really keen about the environment. They just want to present themselves in a positive light with misleading marketing, but they have no desire to actually impact the environment positively. They are just like profits. They come with a profit motive. They only mislead investors to get in more capital. And in that case, you have to be very, very critical and do your research thoroughly before you invest in a company that claims to be supporting the environment. Number five is higher complexity in evaluation. Higher complexity in evaluation. Assessing both financial and impact performance requires sophisticated evaluation models, which can complicate the investment decision-making process. You don't just, unlike normal traditional investing, you could just choose one or two or three or several parameters or metrics and do your analysis. When it comes to this particular area, it's a bit complicated. It's not as straightforward as what is obtainable in traditional stock market analysis. You need a level of expertise. Number 6 is potentials for conflicting goals. The dual objectives of achieving financial returns and positive impacts may create conflicts, especially when financial goals directly contradict social or environmental aims. It's difficult sometimes to balance these two aims. What do you really want to achieve? You want to make money and you equally want to affect the community positively. So how do you go about balancing the two without creating conflict? Sometimes conflict do arise. So you must be mindful of this particular area. Number 7 is market limitation. Market limitation. Not all sectors or industry may offer viable finance force impact improvement or impact investment opportunities, which can limit the available options for investors seeking to balance profit and purpose. So you discover that companies that are really environmental friendly are kind of limited in number. So you discover that opportunity involved therein are kind of limited. Number 8 is regulatory and compliance and challenges. Navigating the regulatory landscape for impact investment can be somewhat complicated, particularly when trying to ensure compliance with both financial and impact related standards. So it's kind of a bit difficult. Sometimes the government regulation may kind of come against your desire to really impact the environment, to really carry out, to balance the two, from financial performance as well as obtaining a level of environmental impact. So regulatory challenges may come in, and that will affect the overall performance of the investments. Number 9 is performance measurement difficulties. Measuring impact accurately can be challenging, as there is often no standardized framework for quantifying social or environmental benefit, leading to potential inconsistencies in reporting. How do you really, what yardstick are you going to use to measure impacts? All right. Are they universally accepted, standards you could use or metrics you could use to identify the magnitude of impact you've achieved in a particular investment? Please, if you have something tangible, you could indicate in the comment section. Number 10 is investor skepticism. Some traditional investors may remain skeptical about the viability of finance first investing, viewing it as less credible or more risky compared to conventional investments. And so these disadvantages, highlights the complexities and challenges associated with finance and first impact investing, emphasizing the need for careful evaluation and due diligence before you venture into this particular space. It is not as easy or as plain or as simple as we think it may be. It's a little bit complicated. I have to be very careful before we dive into this strategy as investors.